Hello friends, last week in my video I basically discussed with you whether bulls had the wherewithal in them to take the Nifty to an all-time high and whether follow-up buying would be coming in. And I expressed my reservations about a few aspects of the market that bothered me, and I used the word "this is what is bothering me" in this clip, as you can see this recap here. Last week, especially on Thursday and Friday, I noticed something that was very, very disturbing. And on that, one of the reasons is this reason which I am pointing out now is what will depend whether the markets are able to notch up fresh lifetime highs on, before, or around Diwali, which is very, very shortly up ahead. You see, the turnover, which is the participation levels of the retail, HNI, institutional players, etc., fell very, very sharply. Where index futures turnover is concerned, I'm talking about in terms of number of lots traded, it was the lowest since 17th of September 2024. Not a problem. Not a problem at all. But stock futures turnover in number of lots traded was the lowest after 18th of March 2024. That is a problem. If at all bulls want to take the market higher, why would the turnover fall to almost 7-month lows? I'm not done yet. Now, you would say, Vijay, derivative prices do not impact the stock prices because the spot levels determine the derivative price and not the other way around. All right. So let me show you where the spot turnover has been. By spot, I mean the delivery segment. It was the lowest since 20th of March 2024. Now in this week's video, I want to take this forward and see what's bugging the markets, what's impacting sentiments in the markets, obviously based on statistical data, because that's what I believe in. On your screen right now is the weekly market roundup window, which basically tells you that it was a broader based Nifty 50 which fell, whereas the bank Nifty actually gained. And that was all thanks to the rally that you saw on Friday in the markets. Now, I have been telling you that the banking space is very, very important because of 32.6% weightage of the bank Nifty in the Nifty 50. And if it hadn't been for the rally in the bank Nifty, the Nifty would have fallen even further. The US dollar index went up yet again, and that pressurized emerging markets, including India. And that also basically saw some amount of profit taking in crude oil and natural gas, which I have been telling you I do not subscribe to the super cycle theory. Gold and silver went up in spite of bullish US dollar. You all know why. I've made this video on 8th of April with a follow-up video on how and where to buy bullion at honest to God prices. Now the USD INR, which is the dollar versus the Indian rupee, fell a little, which means the rupee strengthened marginally against the dollar. Indian 10-year benchmark bond yields rose 2 basis points, which means bond yields fell a little, and that capped the rally somewhat in the banking space. NSE market capitalization fell 0.86%, which means the sell-off was somewhat broad-based. Market-wide position limits, MWPL, went up a little over 3%, which means traders continued to build up exposure, and the US headline indices continued to rise and thereby provide tailwinds to our markets. Friends, I now come to the ratio chart of the Bank Nifty versus the Nifty 50. Like I said, 32.6% weightage is what makes this ratio so very important. Now, we are at a multi-week high as far as this ratio is concerned. As you can see, the last candle is a fairly bullish, prominent par candle. The ratio chart is precariously poised at its 25-week exponential moving average, which happens to be the 6-month long average in the market. And that's a level where average retail investor holds his trade for. So now if the Bank Nifty versus the Nifty ratio chart was to basically climb up and go above the 2.20, if not 2.25, there is a better probability of the rally sustaining. This is one of the first few criteria. And take a look at why I've been talking about the Bank Nifty versus the Nifty. This weightage explains a whole lot of things to you. This also explains to you why, in spite of all the warnings by the RBI in the banking and financial space about evergreening of loans, MSMEs or even NBFCs, personal loans, credit card debt, etc., the banking space continues to go up. It's because of the sheer weightage. Market men realize that unless this sector goes up, a broader base rally can not happen. Friends, I now come to our in-house statistical indicators, starting with the MWPL. Why is MWPL important? That is explained in this video. The hyperlink to every video that I want you to see is in the description below this video and in the pinned comment below. So MWPL has risen very sharply to 43.82%. Now that tells you that traders have ramped up their exposure levels and they are writing out bigger checks and creating bigger positions. Now that is good and bad. Why is it good and bad? You'll know as we progress in this video. Number one, high MWPL invariably leads to higher volatility because bigger positions need to get squared up, either on expiry or in case of any adverse news. Now, friends, I come to the second aspect of why I said MWPL rising is good and bad. Take a look at this stock and index future turnover. This is 3-month concurrent series, so it's October, November, and December. What you are seeing is that the index futures turnover given as a blue line is at a multi-month low. If at all bulls are so gung-ho and convinced about the markets going up, my basic question is, why aren't you buying in large numbers? And that I explained to you in the inset box in the beginning of my concerns that I raised even in last week's video. Now let's come to the advanced decline ratio. Here again, there is a small red flag. The Nifty has notched up somewhat bigger losses last week compared to the prior week. That's all right. But the advanced decline ratio has plunged very, very sharply from 1.61 in the prior week to 0.82 last week. The advanced decline ratio is almost half. At 0.82, it tells me there are 82 gaining stocks as compared to every 100 losing stocks. This is not something that a bull market is made of. Bulls need to be made of sterner stuff, tougher stuff, if at all I am to believe them that they are intent on taking the market higher. And at 0.82, this advanced decline ratio is also at a lower end of this 20-week range. Not exactly great, heartwarming news. Now comes the basis analysis. Basis is the discount or premium prevalent on futures compared to spot. Now take a look at what happened in the basis. Basis on both indices has gone up. What does it tell you? In spite of the fact that basis is a decaying asset, exactly like options premium, basis also contracts as expiry approaches closer. The only reason why basis has gone up is that there's been short covering at lower levels. Now, short covering may restrict declines or arrest the declines marginally for a brief period of time, but they cannot take the markets to new highs. It takes fresh buying, aggressive fresh buying to lead to a new high. So I want new evidence of fresh aggressive buying before I can go out there and feel confident about buying there. Now, friends, the impetus chart, our in-house statistical indicator you've been enjoying for almost 4 years and banking upon it. And this is also covered in a post-market summation every day, late night or early morning before market opens on my social media handles. Please do connect with me. My contact coordinates come at the fag end of this video. Now, so far, the indices were kind of falling, and the impetus was rising. That told me that selling was forceful. Last week, the impetus has collapsed on both the indices. And do note, the Bank Nifty has risen. Now, when the Bank Nifty has risen and the impetus has fallen so sharply, that tells me that the buying wasn't exactly backed by forceful, aggressive retail purchases. This was more of short covering, and that is confirmed by the basis. Basis has gone up last week on the Bank Nifty. So obviously, some short covering has come up. Although short covering is welcome, that also tells me that there is not much of fresh selling. But hey, like I said, I want fresh buying. Unless that comes, I don't think fresh new highs are coming in a hurry. Now, friends, I come to our lift weight thrust drag indicator. You've been using it for almost 3 years in a row now. It has stood the test of time, and this is the weekly version. The daily one is on our social media accounts, posted every day post market. Now, the Nifty is indicated as a blue line, and it has notched up bigger losses last week. And the LWTD indicator has also plunged. From 0.21 in the prior week, it fell to minus 0.20 last week, which means fresh buying is likely to be very, very limited. Not really very surprising, because festive season is around the corner, expiry is in the week after that, and retail participation where intraday turnover is concerned has been quite poor. It's at a multi-month low. So fresh buying has to come. Otherwise, I think the market might just encounter resistance at higher levels. Friends, the E-Now indicators done. I now come to the bond markets, which are the indicator of which way prices of other assets are going, because this is a fountain of money supply for the other markets. Take a look at the Indian 10-year benchmark bond yield, a weekly chart on your screen. As you can make out, the Indian bond yields have gone up by 0.02% or 2 basis points. Now, I've been telling you that between 6.50 to 6.75, maybe 6.80 is the range at which I feel bond yields will start to consolidate, and that's what has been happening. Now, the price, the bond yield chart is in a lower top, lower bottom formation. I would feel comfy if 6.90% was to be overcome on the upside very, very forcefully, and then I would take a fresh call. Right now, I'm neither doing anything in the gilt funds, nor am I doing anything in the sovereign bond segment. Remain assured, I will update my Telegram channel first, foremost, and always. Also, the WhatsApp channel follows later. Contact coordinates are at the fag end of this video and in the pinned comment below this video. Friends, the bond market's done. I now come to the Bank Nifty, which was the only gainer out of the two indices. It gained 1.80%. And as you can see on the daily chart on your screen, this index has risen on 2 out of 5 trading sessions, and both being Monday and Friday. Price has closed above its monthly moving average, which itself has been sideways to down. And it is also interestingly poised at the upper trend line of the bullish wedge. Consistently pushing higher will be required to keep up the bullish momentum. Now let's switch to the weekly chart. What you are seeing is a bullish candle, which has been taking support at the 6-month long moving average, which is the 25-week exponential moving average, which is a proxy for the average price of an average retail investor. I've been telling you that I trust this average as a medium-term support, and this support held. So I think I would watch the 50,850 level as a level that bulls will need to defend constantly if the market is to rally in the coming week. Although I would want 52,750 level on the upside to be overcome very forcefully. Unless that happens, I think a sustainable rally might just be missing. And I also want volumes to be extremely high. Do remember, I've been expressing concerns about the poor volumes. It's a red flag. The poor churn ratio across the board in both the Nifty and the Bank Nifty is another bit of statistical weight of evidence that it is the retail segment which has been doing all the heavy lifting, that is buying. And I'm not happy with that. FIIs are selling. Institutional investors in the domestic segment are definitely buying, but not as aggressively in the derivative segment. So the retail guys have been trying to pump the market higher. I don't think they can do it single-handedly. Like I said, 50,850 level needs to be defended on the downside, and 52,750 level needs to be overcome on the upside. Friends, in the week before last, this index was number 3 on the most volatile counters list on statistical beta ranking that I maintain in-house. It fell 4 notches to number 7. Now, it's not necessary that the challenge level or the volatility of the Bank Nifty has fallen. It's also a function of the volatility of individual stock counters having risen faster than the Bank Nifty, which is why the Bank Nifty's ranking has come down. So challenge levels need not have gone down definitely. Last week, I advocated an estimated range between 52,700 on the upside and 49,650 on the downside, which held perfectly well. In the coming week, I estimate a range between 53,575 on the upside and 50,600 on the downside. In addition to these ranges, please do monitor the daily, weekly, and monthly pivots that are available on our free Telegram and WhatsApp channels. Friends, the Bank Nifty done. I now come to the Nifty 50, the broader of the two indices, but this index actually lost 0.44% in the spot segment last week. And as you can see on the daily chart on your screen, this index also rose on 2 out of 5 trading sessions, that is Monday and Friday. The 0.42% gain of Friday saved the day for the bulls, because had it not been for that, this index would have fallen almost 1%, and that would have basically seen market declines being even more deeper. The daily chart on your screen also shows an evolving head and shoulder pattern which is marked by a red line. Why am I saying evolving? Because the price has not yet conclusively closed sustainably below this level, and purists, those technical analysts who behave, who expect chart patterns to behave in a textbook manner, will want at least 2% decline below the neckline sustainably before they would say that the signal is validated. The price is below the month-long moving average, which itself is down, so the short-term outlook is nervous as of now. Switching to the weekly chart, it shows a bearish candle, which is a third bearish candle in a row. So the outlook is tentative. I'm not using the word bearish or nervous. I'm using the word tentative because the bulls don't know which way they want to take the markets, up or down. The price is above its 25-week exponential moving average, which doubles up as the 6-month-long moving average, holding on cost of an average retail trader. So the medium-term outlook is positive for now. The 24,250 level, which I advocated as a support last week, held, and which is why the Nifty did not fall too much. But this support level has now moved up marginally to 24,300 levels. This is what bulls will have to defend the 24,300 mark if the rally is to sustain momentum. I will feel comfortable that a bull market is back in place only after the previous all-time high above 26,200 is overcome. That might look like a lot of distance to be missed out on, but that's all right. I don't mind getting a confirmatory premium that I would have to pay on long position. Friends, in the week before last, this index was number 7 on the most volatile counters list on the statistical beta ranking that I maintain in-house. It slipped a whopping 20 notches, like I said in the Bank Nifty segment below. Not necessarily because the volatility has fallen in the Nifty 50, but also because individual stock counters volatility went up very, very significantly. Now, last week, the estimated range was between 25,575 on the upside and 24,350 on the downside. These levels held perfectly well in spite of all the volatility, and in the coming week, I estimate a range between 25,475 on the upside and 24,250 on the downside. In addition to these ranges, please also monitor our daily, weekly, and monthly pivots that are uploaded on our free Telegram and WhatsApp channels. Friends, I now come to the last bit of statistical analysis wherein I monitor the retail risk appetite by the footprint of the turnover contribution in the four segments in the derivative space. On your screen right now is the weekly chart of the retail contribution of the turnover. The index futures turnover contribution, as indicated by a blue line, was constant, marginally lower in fractions. Stock futures turnover went up by 3 basis points. It's indicated as a red line. Index options turnover fell by 43 basis points, indicated as a green line. Now, between index and stock options, the index options are relatively less volatile. So, turnover falling on the less volatile segment tells you that traders wanted to go into the relatively higher volatile segment, which is what happened. Stock options turnover went up 41 basis point, indicated as a purple line. So risk appetite went up, but where? It went up in the options segment, not in the futures segment. So retail guys, like I said earlier, the statistical weight of evidence is compelling me to say that it is the retail guys who are buying, and these guys are not necessarily very strong hands. Another small but red flag here. Now, friends, I come to my strategy for the week ahead. Do remember, it's holidays are approaching for Diwali, and retail segment participation might fall even further. So my strategy remains more or less unchanged. I will seek smaller exposure with larger price move. The strategy is explained in this video here. Now, this cuts down the risk onto my capital, and at the same time does keep me in the market and possibility of alpha or pure rupee gains as an open possibility for me. I'll continue to hold tail risk hedges or Hacienda hedges, which I have explained in this particular video, because I think poor volumes lead to exaggeratedly large price moves, and I don't want adverse price moves to hit my capital. I will focus on the public sector units. Why? Because that is explained in this video of last year. These are relatively cleaner stocks to trade where interference and price influencing is concerned. Do watch that video, please. And within the PSU space itself, I will focus on PSBs, public sector banks, OMCs, oil marketing companies, energy, defense, power, and logistics stocks. Why? Because these stocks will give me large intraday price moves in both directions. So as long as I can get my direction right with tail risk hedges in place, I stand to make higher alpha or absolute trading profits. I remain pessimistic on the outlook on oil and gas, which is why I'll continue to pursue my theta decay strategy on this segment. Barring any geopolitical unforeseen events, especially after the death of Yahya Sinwar in the Gaza war, I think prices of both oil and gas are likely to run into resistance at higher levels. So even if disruptive price rises do come up, they will be temporary rather than a complete trend reversal. So theta decay, like I said, continues to remain in place in the energy commodities, as well as interest rate sensitives in the equity segment. I still remain bullish on Bullion, like I've mentioned in these two videos. Number one, why Bullion is bullish, and number two video, where you can buy pure, low-priced, honest-to-God prices bullion from the Zaveri Bazaar or the jewelers market in your city and get it tested and verify the purity of the gold and silver that you buy. Now, I've been positive on Bullion for many quarters, as I have been telling you in my weekly strategy segment of my videos, as well as my weekly live mint column, which is India's first and only media column to offer statistical inputs to its readers. What is concerning me is the significant buildup of market-wide position limits, or MWPL. Why is MWPL important? I've marked in this video. I've explained this in great detail in that video. Please do understand the concept of MWPL. Nobody, unfortunately, talks much about it, which is why we real-world traders need to know what actually needs to be done rather than bookish academic knowledge. Now, the rising MWPL across some select counters raises the probability, or the specter, I would say, of crowded exits. Now, that's not really a very healthy thing to happen, especially in the heat and smoke of the war in Gaza, especially if it escalates after the death of Yahya Sinwar, who's the leader of Hamas. Now, those of my online family members who've finally mastered how to calculate the churn ratio, the ticket size per trade, and the MWPL have been reverting back to me on our social media platforms, especially email and WhatsApp, etc., about the counters that they are monitoring. Hey, I unfortunately, due to SEBI guidelines, cannot name names, individual stocks and trades, so I'll refrain from it, but I will just tell you one thing. You guys are doing a tremendous job. You've got it all figured out, the TST, the churn ratio, and the MWPL, and you are somewhat prepared for what lies ahead in the year 2025. Now, as far as industrial metals are concerned, I still stick my neck out and say there is no super cycle. Yes, there could be sporadic rallies, and especially since the month end is coming across next week onwards, and from the 25th onwards on the MCX, metal counters will go into delivery mode. Therefore, delivery settlement will mean that turnover will then shift to the following month, which is November series. So you might see A, cost of carry based premium, B, short covering itself in the international markets. Now, as and when outsized moves occur in the base metal prices, you will see that price movement increases in the stock prices of metal mining stocks as well. So these are sectors that you need to watch out for in the week ahead. If there are any more ideas that I need to convey across to my online family, please do monitor our Telegram and WhatsApp channels. The contact coordinates at the fag end of this video. I would be more than happy to share my thoughts there. Friends, before I wind up this video, a reminder to subscribe to my YouTube channel if you haven't already done so. This is a labor of love. It takes time, effort, and money to make these videos. So if you can please share these videos with your friends and family, it will help me to reach out to a wider audience to convey the idea of knowledge-based investments and trades. In the comment segment, do let me know what you would want me to record next in my videos, and I will try and make sure that I comply with your request. Thank you for your patience and being with me in this video. Till we meet again in my next, this is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Take care. Bye-bye.